Good morning. The G20 has extended its debt moratorium, so if you owe anyone money, forget it. It does not apply to you. Here's the breakdown. U.S. markets remained nearly flat yesterday, except the small caps, which lost 1.70%. A bipartisan bill is sailing through the House to bolster U.S. tech research as it battles with China. In a foot-to-foot his infrastructure bill, President Biden said he was sick of companies neither paying taxes nor investing sufficiently in development. The FOMC's minutes yesterday revealed concern for those sectors hit worst by the COVID pandemic and a commitment to continue its accommodative policies. The dollar is subdued at the moment after mortgage rates increased a tad, quashing applications by 5%, and the nation's trade deficit increased by $4 billion to 71. Canada, on the other hand, is boasting a $1 billion surplus, down from January's 1.2, but still better than expected. As we can see, the dollar index is now retracing its late March rise, fitting in perfectly with those very same Fibonacci levels. If we do break below 92.12, we could once again verge towards the 91.30 support level. We'll see how that works against the Aussie in a couple of minutes. Major European benchmarks were down yesterday. The odd man out, the FTSE, gained nearly 1%. The pound is up a fifth, with the euro lagging, as service and composite PMIs exceeded expectations. Italian services missed out, but the EU services are now just a half point beneath the expansionary 50. Measures soared by 7 points in the UK, but still mixed expectations by a half point. This alongside a better than expected 59% housing price balance. Asian indices are all green this morning, led by New Zealand's Dow at 1.25%, despite an 8-point contraction in business confidence. Only the Nikkei lost 0.25%, with the yen slightly up as the nation's current accounts registered a 2.9 trillion yen surplus in February. The yuan is down today against the dollar as Chinese health shares soared on boosted vaccine rollouts, and the People's Bank lowered its rates by 20 pips. In a phone call between President Xi and Germany's Angela Merkel, the Chinese leader called for tighter cooperation with the EU. The Aussie gained some traction overnight. We can see that we're still in a narrow 60-pip range, with volumes over the past day or so being mainly bullish. A breakthrough to the upside could easily target 77.60, while the downward margin is much narrower, 75.60. To help us gauge all that, we'll be getting jobless claims from the U.S. at noon, which is expected to decline somewhat, and the Aussie Central Bank Stability Report at 1:30 after midnight, alongside building approvals. Both are expected to increase dramatically, and both of them follow the services index at 10:30 tonight. Lumber is up 31% on supply shortages. Oil continues bound in the $59 region despite a surprising 3.5 million barrel EIA drawdown. That's double expectations. The culprit here is the 4 million barrel surge in petrol inventories. Gold still hasn't reacted to the latest dollar slither, and Bitcoin is down about 1% as PayPal co-founder Peter Thiel warns against the token. At the Nixon Foundation roundtable yesterday with former State Sec Pompeo, the venture capitalist said he feared that China was using Bitcoin as a financial weapon. He said he was pro-cryptos, but wondered whether they weren't being used to dethrone the dollar as the world's reserve currency. Thiel also believes Google and Facebook are being used by China. We'll never know. Bloomberg today reveals that Twitter is negotiating a $4 billion purchase of the Clubhouse audio app, and after Intel's latest bid to create $20 billion worth of U.S. manufacturing plants, it now reveals that its latest data center processor was developed in Haifa, Israel. The new chip is said to be 46% faster and already in demand by major cloud service providers. Finally, we should welcome David Chipman to the role of U.S. Alcohol, Tobacco, and Firearms Bureau, a former head of the Giffords Gun Control Group. We can only hope he exerts some control. See you all tomorrow.